This is Chapter 2, Business Combinations. Acquisition method procedures for consolidating financial information when either dissolution takes place, and that simply means that BigNet, in our examples, buys Small Port disappears as a separate company. So actually all that's happening when BigNet dissolves Smallport is that they're buying all of their assets, all of their liabilities, and just issuing stock in exchange. Versus separate corporations are maintained, which means even though BigNet buys some part or all of the other company continues to be run as a separate individual company, a separate corporation in this case, because we've got retained earnings and we've got common stock. But these companies continue to have separate financial statements, and then we have to consolidate them, put them together. And that's really what the rest of the course is going to be about, is not dissolving the second company, but keeping two separate companies and consolidating their financial statements, presenting their financial statements as if they were a single company. That's what's done for most major corporations, because most major corporations consist of many small companies, like hundreds, many companies, or many even hundreds of small companies, and they have to be consolidated into a single mothership, as it were. Anyway, let's start with the dissolution. That's the most accessible one. So I copied this from the book. We have BigNet and Smallport. We have their assets, liabilities, and their revenues and expenses, retained earnings, everything that we need. Okay, BigNet pays to Smallport shareholders $550,000 in cash, 20,000 shares of previously unissued stock of their own, with a fair value of $100 per share. And if you do the numbers here, the total value is $2.55 million. BigNet gets all of the assets and liabilities of Smallport, and Smallport no longer exists. It disappears. So essentially they're buying assets and liabilities. To record that acquisition, they record, now obviously most companies would have these enumerated, listed, but for our purposes, they buy the current assets. You'd list your current assets. It's not just current assets. This is just expedient again. You'd show your cash, your investments, whatever the current assets are. You'd list them out, accounts receivable. This is just because it's easier for us to see. Current assets, they got their computers and all of this stuff. All of them at, of course, fair value. They got the notes payable at fair value. They paid out cash. They paid out 20,000 shares of common stock. And the value of that common stock was $100 a share. So the other $90, $100 fair value, $10 par, the other $90 is additional paid in capital. We always record common stock at par. When all else fails, remember in your journal entries, debits equal credits. Then you can go back and defend your number. All right, what happens if BigNet pays $1 million? So that would mean that the total value of their purchase is $3 million. The extra $450,000 that they pay must be goodwill. So they get the same assets, they get the same liabilities, but look, their cash has gone up, and you have to balance your journal entry, and that's the goodwill part. What if they agree to pay $2 million, less than the fair value? That's $550,000 less than the fair value. What happens? Well, what happens is that they get the same assets, they get the same liabilities, they issue the same common stock because it's $100 fair value. So again, you have to balance your journal entry, and your balance on your journal entry in this case is that there's a gain on a bargain purchase. They got a bargain. Just note that acquisition costs such as professional services like legal and accounting are recorded as period costs or period expenses. That means they're recorded in the income statement as expenses for the current accounting period. But the cost to register and issue the stock that BigNet has issued for this purchase decreases their additional paid-in capital.